Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. It's January 22nd. Thank you for joining us, Ernest. Thank you for joining me today. How you doing?
Good as always.
I'm well too, thank you. And we really appreciate all our listeners following our podcast. If you like the Long-Term Investing Podcast with Baskin Wealth, please subscribe to our podcast on Spotify, on Apple, and on YouTube. We try our best to put a podcast up every week, and we really appreciate if you would leave us a 5-star review because we love our fans and we hope that you love us. Ernest, we got a bunch of things to talk about today. First, I want to talk about a little bit of our lessons of buy and hold strategy. I was looking at our portfolio the other day and was very interested to see how well some of those stocks have done and the reasons why. Then we're going to talk about the exciting Netflix earnings. The stock popped at one point, I think 15 or 16%. It's pulled back a little bit from that, but still we'll take it. And then we're going to take your questions. It's all about you. We asked for your questions on Twitter, and we got about 20 questions. We picked a good number of them, and we'll go through them and give you a shout out. So let's get going. So, Ernest, I looked at our top 25 holdings. There's a little bit of a bragging here, but I think we're allowed since it's our podcast. Out of those top 25 holdings in our portfolio, 19 of them, Ernest, are multi-baggers. That means a stock that's gone up more than double. And we're pretty excited about that. And out of the top 25, 19 are multi-baggers. 6 of them are up-and-coming baggers. Some of them we haven't owned for as long, or some of them we just bought recently. So it's our slugging percentage, so to speak, using a baseball term, has been pretty darn good. So that's, I guess, the strategy of owning good companies, being patient with them. We've talked about it before on the podcast. We've owned many of these names for 5, 10, 15 years. Investing and compounding in the market is not a get-rich-quick scheme. It's hopefully get-rich slowly, but looking at the names that we own, the top 25, certainly I love every one of these companies. Ernest, you've seen the names. Anything you want to add to what I said?
I think more importantly is that almost all of these businesses have evolved in ways that we've never foreseen.
Great point.
When we first bought these companies.
Yes.
Give
some examples.
Yeah. So when we bought Apple, that was even before my time joining Baskin. Mm-hmm. I would imagine that you didn't envision that the iPhone was going to be what it was.
No idea.
Yeah, you saw that people were using it. It was a revolutionary product, but you didn't think that people were going to be spending like 5-6 hours a day staring at their screens.
No, but at 12 times earnings, it seemed like a pretty good deal at the time.
Right.
Yeah.
And I think that's, like, if I look at the list of names, like Apple, Google, Constellation.
Well, we're not going to give away all the names.
Okay. They I think all of these businesses have surprised us in ways that, in pleasant ways.
What's also striking to me is, Ernest, when I look at the names on our portfolio, only a handful of them are Canadian only, right? So our portfolio is mostly U.S. high quality. There's only one international name in our top 25. That's Ferrari. I guess it's an international name, but it trades on the U.S. stock exchange. So our portfolio is highly concentrated and mostly large companies too, but not necessarily. I see a few names here that are 5 billion or 10 billion or 40 billion. And of course, we own one company that's almost 4 trillion. So you can find ideas and opportunities in all different types of sectors and market caps. For now, we're really focused on the U.S. We've mentioned our reasons many times why we like the U.S. over many other different countries. That could change in the future, but the hunting grounds that we found right now are primarily US and Canadian quality names.
No, and I think that was a good point with regards to the international things, because a lot of people often ask me, they say, well, why are you so focused on US stocks? Why don't you own stocks in the rest of the world? And like half of the answer is that, like, just because they're listed in North America, it doesn't mean that they're not global companies. Like Netflix, for example, is the company we're going to talk about later. They, over half of their subscribers and revenues come outside of the US.
It's a great point.
So that is international by all definitions, apart from the fact that it trades in the US and is headquartered in the US.
And we're not trying to knock, and there's a lot of great international businesses that we would like to own. Maybe we haven't gotten around to researching them, but it's, we're in the business of, is company B better than company A that you already own? And when you're going to sell company A, you may have a capital gain. So company B has to do a lot better than company A. A lot of variables out there, right? So for us, we like to stick what we own. And from what I'm learning here from the companies that in our top 25, like I said, we've owned a lot of them for such a long period of time. And I'm always of the mind that if the fundamentals are improving, stick with it, right? And we'll talk, I think that's a perfect segue to talk about Netflix.
Yep.
Because at one point in time, Ernest, everybody said the Netflix story is over. It's kind of reminiscent right now to what people are saying about Apple, by the way, right? Global platform, everybody uses it, everybody loves the product, but the growth is slowing and we don't know. And the story's over. But there's been obviously a gigantic renaissance in the Netflix story with accelerating growth in this quarter and previous quarters. So you read the most recent investor release. Did you listen to the conference call?
Yep.
So let's get into it. Netflix.
It was an incredible quarter.
Wow.
They added 16 million subscribers.
I thought 19.
Oh, 19 million.
Okay.
Okay, sorry. 19 million subscribers.
Yeah.
So they added 19 million subscribers. It beat it was the most subscribers they ever added in any quarter. The previous was 16 million.
Is that because of the Mike Tyson fight?
So according to the management, they said it was not.
Yeah.
They said that it was very broad-based. I think 15 million out of the 19 million came from outside of North America. So most of those people don't really watch football.
Yeah.
So it was very broad-based interest in subscribing for Netflix, and leading to a very strong outlook overall in 2025 for revenues and profits.
So it's just a number of things that Netflix has done recently that's gotten subscribers interested, whether it's offering the Mike Tyson fight, wrestling, football, live comedy shows, the Squid Game back on.
Yep.
These things just encourage people to sign up, and you're hopeful that out of the 19 new million signups, they don't leave.
Yep.
And they take on new price, and the prices go up on them.
Yep. And that's exactly what Netflix is doing.
Yeah.
There's going to be a small price hike in 2025, actually already taking place in some of its major markets by about $1 or $2.
I think I'm paying $25 a month now for Netflix.
That would probably be the premium tier.
Yeah.
They are raising $1 for the basic, and I think about $2 for the premium per month, and increasing the content budget by about $1 billion next year.
Well, you think about it, $25 a month versus I think it used to cost like 14 or 15. It's a lot of money, but the value's there, right? My wife and I can go see a movie and get popcorn and probably spend like 75 and worry about parking and all that stuff and pay $75 to maybe see a lousy movie. Whereas that's 3 months of Netflix and I can pause the movie to go do what I want, check my phone, not worry about other people around me or annoying other people around me or vice versa. I sound like an ornery old guy, but that's the value of Netflix, right? And they keep putting on so much great content. It's something for everybody.
And extremely profitable as well.
Yeah.
They are going to do about $8 billion of free cash flow next year.
Okay.
And expecting a very strong year overall.
Are you worried that Netflix has to, on this train where they just have to keep spending more and more and more on content every year to keep the subscribers coming up and maybe blowing their brains out on some live events or the wrestling. I know they're paying a lot of money to secure WWE wrestling. I've heard rumors that UFC is now up for renewal. There's no question that Netflix is going to want to at least get some type of their events on their program as well. What's your? Do you have any issues there?
Yeah, so there's two separate questions in there. The first is whether Netflix is just on a continual treadmill of increasing content spend just to make subscribers happy.
Yeah.
And then there's the sports portion, which is kind of related, but not exactly the same question.
Okay.
So the first point is what the market has been concerned about Netflix almost since the beginning of its streaming strategy, which is that it was fundamentally a business. Streaming is fundamentally a business that has no consumer loyalty to the platform. If they have a good show, they'll subscribe, and then once the show is over, they'll cancel, and then therefore they need to keep spending on new content just to keep people coming in.
Yeah.
And I think that's been demonstrated to be completely not true in Netflix's case, because not only do they have the lowest churn rate out of all the major streamers, they also margins and free cash flow have been going up.
Yeah.
Which means that they don't have to spend at the same pace.
Netflix should be mailing me a gold watch for how long I paid them.
Right.
And, yeah.
They don't have to continue to spend content to keep people subscribed.
Yeah.
And more interestingly, and this is one part of our thesis when we invested in the stock, is that because of how people interact with Netflix, what they do is they'll browse Netflix and they'll see, oh, this show is on Netflix, and then I'll watch it, right? They don't go onto Netflix specifically to watch a specific show.
Yeah.
And I don't know if that's super clear how I explained it.
Well, let me give you an example. So my son Lee is he's 18. He's now discovering all the shows that I loved when I was younger. Breaking Bad, Suits, Friends, right? And so they're only on Netflix.
Right.
All these awesome shows that we loved 5, 10, 15, Seinfeld 25 years ago. This new generation, the new Gen Z, are finding these shows and binging them and loving them. And so they've created an amazing flywheel of content.
No, and that's why people are sticking with Netflix, because they have so much content that there's always something for you to watch. Yeah. If Squid Game was produced by any other channel, right? Like let's say it was on Disney Plus, it would not nearly be the same phenomenon that it was on Netflix. And I think and so to summarize all of what we're saying is that that has not happened. What happened is that Netflix was able to grow profits and subscribers and raise pricing in excess of how much they're spending on content.
By the way, I tried to watch the second season of Squid Game, gave up after the first episode. Not for me. We did love the first one, but I guess it's been there, done that.
Yeah. So then with sports, I think there has been some concern about Netflix in that it is starting to play the game that the other TV companies historically have done, which is bid sports rights up to astronomical levels.
For sure.
And try to chase subscriber growth to drive ad revenues going forward.
Yeah.
Especially given how Netflix is focusing on scaling up their ad tier so that they can add inventory.
So Ernest, with sports, no matter what tier you're on with Netflix, you're going to get ads.
Yep.
Right. And there's going to be sponsorship and there's going to be other things there because they need that incremental revenues to help cover the costs. I think they're paying WWE like $400 or $500 million a year. Right?
Well, and some of that is just the nature of sports,
Mm-hmm.
is that there's timeouts, there's breaks in the action, and like, what are you going to do? Right. So that's just how sports are.
Yeah.
But I think what is not well appreciated about Netflix's strategy in sports is that they're not doing what everybody else is doing. They're not spending like $4 or $5 billion on the NBA just to add subscribers that way. Because Netflix has the subscribers already, they're able to buy these, I don't know, so I don't want to say like under monetized, but they're able to buy sports properties that were not distributed the same way as Big Four sports historically.
Okay.
So think of things like they did the WWE deal, right? It's historically only available on one channel.
Yeah.
They bought the rights to the Women's World Cup soccer, right? It's a growing sport and really benefits from having access to all of Netflix's.
The strategy is brilliant.
Right.
Yeah.
Having access to all of Netflix's subscribers. And the one thing that Netflix is very careful about is in structuring these deals and ensuring that the value that they're providing to the leagues is sticking with Netflix.
Okay.
Right. So the example with the NBA, for example, like if you sign a deal with the NBA, upon renewal, then like the NBA will go out and say, now who wants to pay the most for us? And so all the value ends up going to the NBA. Netflix is very careful to ensure that this doesn't happen with them, right? That's why they signed a I think a 10-year deal with the WWE.
Yes.
That's why they are they're looking for these little sports or these lesser viewed sports.
Well, Netflix is the clear winner. There's no competition anymore. And as linear TV, they said it in their investor letter, in their shareholder letter for the quarter. We're not hampered by linear TV hurting part of our business. It's irrelevant to us. We can go out and spend. We can compete, and those guys are going to be hurt. I mean, it's clear, it's inevitable to us that Netflix is going to be a winner. The question is, after this run up that it's had, remember at one point Netflix was $180 stock in 2022.
Yep.
Now, what all-time high, almost $1,000 a share. Is there still value for shareholders in Netflix long term?
I think so. I think what's been made abundantly clear in the last, give or take, like 2-3 years, is that Netflix is just executing on a pace that is well beyond anybody else in the industry.
Yeah.
And their overall market share of time that people are watching content is still very small. I think about 6%. Yeah. So there's still a lot of opportunity for them to grow content. We didn't even talk about what they're doing in video games.
Yep. Well, we'll say that for another day, but it's eyeballs. And if they can get your time and attention, Netflix is going to be a much bigger media beast going forward. So it's mailbag time. Mailbag means we're going to answer your questions. We've scoured Twitter for your questions, and we've got a bunch. We're going to give you a shout out as well. So Ernest, why don't you start with the first one from Simon Handrahan? What's his symbol?
At MOS_investing.
Oh, I think Simon has a Substack as well, so you may want to check it out. Smart guy.
Yep. So he writes, looking back on the last 5 to 10 years, what are the key lessons that have shaped how you look at the next 5 to 10 in terms of your investment process or how you think about quality businesses?
Do you want to start off? And I'm going to think about that one.
I think the main lesson that I've learned is that.
How many years have you been in the business, by the way?
I worked at Baskin for since 2016.
Okay, and you worked at
I worked at another firm before that.
Yeah, so you've got 10 years. You've got the 10 years, so you can look back 10 years.
Yeah, and I think you want to never be like. I think you want to be a little flexible with these things because things change and the markets change. But I think one thing that has consistently been true throughout this time is that management quality matters.
Yes.
And incentives matter, which is an extension to that.
Are these things that 5-10 years ago you wouldn't have thought mattered as much?
Oh, yeah.
Yeah.
When I started out as an investor, and I think it seems as though most investors do, maybe this is because of the way universities teach finance. Like I was really focused on finding like statistically cheap stocks where like it might be cheap on like a sum of the parts basis. Like if you chop it up and then the management is able to do this, then the margin will be this, and then it's trading at like this discount to this other stock.
Yeah.
Like those were the kind of names that I liked looking at when I first started. And they it's really amazing how rarely those kinds of investment theses work.
So what you answered is exactly what I would answer too. And I guess if you spoke to every investor starting out, either they've continued to be on the same track of air quotes value investor
Yeah.
or deep value investor, to either becoming a quality investor or owning better businesses. We're not traders. We don't trade. We buy and hold stocks. We tend to own them for 5 to 7 years. So it's absolutely right. What matters is management. What matters is incentives. What matters is the company's ability to reinvest. The free cash flow per share growth is great, but you got to do something with that free cash flow. And so having the right management, having the right incentives to reinvest those free cash flows at high returns is how I've hopefully grown as an investor as well.
And paying up for the quality business is almost always the better decision.
Yeah.
Well, and yes, like in a theoretical sense, there is like some price that is too high where the other one is more attractive on an IRR basis. Yeah. But what ends up happening in what you see end up happening is that the company that's ahead, so like Netflix is a great example of this. The company that's ahead keeps going ahead. Yeah. And they're still gaining market share, and the market is giving them credit to keep pumping along their strategy. Yeah. While the one who's behind, like the stock price is falling, the employees are not motivated in the company, the strategy is a mess. And so, yeah, like sure, it's cheaper, but which horse do you rather bet on?
Netflix. That's the Netflix versus Disney thesis, right? Yeah. Disney is going to hogtied by the exposure to the linear business, the movie business, which is very hard. I'm not so sure how profitable it is on their streaming business as well. Their parks business is great, but that it's a totally different beast. There's no two businesses that are exactly comparable.
Yeah, no, and that's exactly right. So
all right, so I think we covered Simon's question. Simon, thank you so much for asking a question and following us, and we look forward to more tweets from you. Let's move on to the next one. We'll do this one. This is from George Mallory. George, it's at George HT Mallory. and George asks, you recently posted the comments from the CEO of Adobe regarding the company's share price and his message to shareholders stating, I say it's an incredible value right now. With $25 billion share repurchase program currently in place, would you rather have the CEO stay quiet? Did you read that article, by the way? It was an interview with Adobe CEO Shantanu.
Right. I think the question that he's I think the tweet is a little bit longer than that.
Yeah, okay.
But
I cut it off. Sorry.
I think the question is, would you rather if the company's stock price is cheap, wouldn't it be better if the CEO just stayed quiet so that the stock price stayed cheap and he can buy back more stock?
Especially when they're at $25 billion share buyback. Adobe has a market cap of about $200 billion. So like Adobe's looking to buy back, not necessarily in 1 year, but almost, more 12, 13% of the company.
Well, I don't think it matters. Yeah. I think he said the stock price was incredible value and they're going to buy back stock and the stock fell.
Yeah, the stock fell.
So anyways. It's not like it really changed anything fundamentally.
No.
But I think there's probably some other ancillary benefits from saying something like that. Yeah. Because it gives confidence to existing shareholders. It gives confidence to the people that are working there that we believe in the future. So,
unlike Mark Leonard at Constellation, if you ask him, he'll always tell you his stock's too expensive.
Well, Mark Leonard is. This is related to the last question. Yeah. Is that the more businesses you study, the more you realize how weird Mark Leonard is as a business person. Because he would always talk about how it's not ethical for a company to do share buybacks. Yeah. Because you're basically buying out, like if the stock price is cheap and you do a buyback without telling other shareholders, the management is taking advantage of uninformed shareholders by buying them out at a cheap price. Okay. Right. And I can't think of another executive who's even spent any time thinking about that question. Yeah.
But there's momentum investors. So when Adobe was $600 a share a few months ago and everybody loved it and everybody said it was the AI winner, there weren't long-term shareholders in there. There was these, algos and momentum guys in there. They buy stocks that keep going up, and once they're not in there. So I don't care if they're not benefiting from the share buyback. Long-term shareholders should be the one that benefits from it.
Yeah. So, well, I mean, I agree with him. I think the stock price is very attractive for Adobe.
I guess what I would like to see is Shantanu put his money where his mouth is and actually, well, first of all, let's not poo-poo. He owns a lot of stock.
Yep.
But it would be nice to see Adobe's board of directors and management team actually buy the stock here with their own hard-earned money, given if they really think the stock is that cheap. We tend to agree. We, as you said, we think the stock's quite attractive here. And I don't think it's necessarily an AI winner or an AI loser just yet. It's too hard to tell.
Yep. Okay.
So thank you, George. Let's go. Ernest, you'll take the next one.
Yep. Tyler Ferris, always learning, always, I think it's growing. Okay. Do you think unoptimized companies should command a higher multiple or a lower multiple than fully optimized companies? As an example, big tech such as Meta have shown that they can operate with fewer employees, but actively choose to retain excess talent instead of profit.
So optimization, we're assuming he or she means that running it with more or less employees optimizes fewer employees, less optimized is more employees.
Well, I think where he's going with this is that should something like I think we're in this example with Meta, I think he's suggesting that they have too many people versus what they should plausibly operate with.
Who are we to say?
Right. But
we don't even know what they're working on in the next 10, 15 years. Yeah.
I think this is not exactly answering the question, but as a general comment, I would say that the market generally rewards like well-run businesses with higher multiples.
Yeah.
And being well-run includes being prudent with the amount of employees that you have and ensuring that you're allocating your expenses smartly. I
mean, Meta is such an amazing business, right? This is a gross margin business with 80% margins, right? So if they have 20,000 too many employees or 10,000 too many employees, I don't think it's going to make that much difference as long as they can keep up those 80% margins and those top line revenue growth. Where does growth come from? It's not thin air, right? You need people to research, data engineers. And of course, like I said, Meta's not what they're working on today is what they researched 3-5 years ago, right? It's not like AI boom, all of a sudden they came up with it today, or the reels or whatever they've come up with, right? So we assume that a lot of those people are very busy working on new projects that will lead to growth going forward for Meta.
Yeah, I would say we try not to own unoptimized companies.
I would say, yeah.
But then there's always going to be some waste. Like if somebody bought Baskin Wealth and had fired the head of research, then that would be a more optimized multiple.
If they fire the chief investment officer too. So can you give an example of a company maybe that we used to own that you thought was unoptimized?
I think the classic example that people like to say is Google.
Okay.
Where it does seem like there are a lot of pet projects inside that are not really, you're not really sure if they're contributing to revenue or value generating in even the medium term.
Yeah.
So, for example, like they even have a separate disclosure for this section called Other Bets.
Yes.
Right. And it's losing like billions of dollars every year.
Yeah.
So, it's always been an open question whether Google should have these kinds of things.
Yeah.
And I don't think it really impacted the return of Google either way. Like if it was Mark Leonard running Google, it probably wouldn't be there.
Yes.
But he's not running Google.
He's also not running that type of company. He's more running a private equity company, buying companies and optimizing them for performance, not necessarily for long-term growth.
Right.
But he probably a bit of both is the right approach. Okay, we'll move on. Thank you so much, Tyler, for your question. Let's go to John D at Axion_FX. And John asks, does the impact of U.S. tariffs affect Baskin's stance or conviction on Canadian energy? He finishes off to say, of course, these companies are going to continue being free cash flow machines. He's referencing CNQ and Tourmaline Oil, two of our investments. I also own them as well. Just curious to hear the team's short-term and long-term outlook. So lot going on there. U.S. tariffs and our short and long-term stance on Canadian energy.
I think somebody else also asked about this.
Okay, so we'll kill two birds with one stone, so to speak.
The current timeline Trump that people are kind of throwing out there is February 1st for possible tariffs. I think it's not really clear what exactly Trump's motivation for the tariffs is.
No idea.
He's kind of talked about he's talked about, for example, like drugs. He's talked about like illegal immigrants. He's talked about like the trade deficit. It's not really clear what he's after.
And some of those issues he's already got some improvement on, right?
Right.
Canada and Mexico have spent money to try and improve their, their services at the border crossing, what have you.
But let's play this out. All right. So let's say he puts a 25% tariff on Canadian oil and gas.
Yeah.
I think the way that it would work in practice is that the refiners are well, first of all, the way that the pipeline systems are set up is that in certain regions in the U.S., mostly in the Midwest, those refineries are connected by pipeline to the energy industry in Alberta.
Okay.
The refineries are set up to process Canadian heavy crude.
Mm-hmm.
And they just have no other options for accessing crude oil.
Yeah, totally.
So they are reliant on Canadian crude.
Yeah.
It's not they can't just take oil from somewhere else and like move it there and refine it and make gasoline and all those things. Yeah. So those refineries are going to have to pay higher prices for Canadian energy.
Yep.
Now, I think what will probably happen is that the flip side is that Canadian energy producers don't have a lot of other options as well.
Yeah.
Like sure, TMX came online, so they have some options in Asia now, but you'll probably see differentials, or you'll probably see differentials on Canadian oil widen as well. Mm-hmm. So it'll be bad if you own like heavy oil producers, especially those that are more focused on what bitumen, like undiluted bitumen.
I think we can play this what if scenario out, but the bottom line is I don't think we expect any tariffs to be long lasting or significant. And if the stock prices of CNQ and Tourmaline do fall precipitously, I think we'd be very interested in increasing our positions. Those are two companies that own tremendous amounts of reserves. Long term, the need for their products is only going to grow in the short to medium term, in our opinion, especially for natural gas. Pretty excited about that. Go check out Project Stargate. So I think the bottom line is it may cause volatility in the short term, but I don't think it's going to change our stance or conviction long term, right?
And there are offsets as well, in the sense that to the extent they're like differentials widen, the Canadian dollar might fall, so they're still getting more money from selling in the US dollars. Yeah. For Tourmaline specifically, there's still the upside from LNG Canada to look forwards to, which is kind of the whole point of developing this project, which is so that you're not necessarily reliant on the US as a trading partner.
Well, yeah, exactly. Canada needs leadership to figure out to diversify its demand for its resources, right? And that should be priority number one for new leadership, which hopefully we'll see sometime this fall. So let's move on to the next. Let's take one more.
Maybe Trump will take over Alberta.
Maybe. So which one do you want to do? There's a Fartcoin question.
Okay.
We're not trying to say bad words on air here, but it's a real coin.
M Nello. So at Mike Nello, a key trait in investing is the ability to hold a stock you believe in through periods of volatility. For example, Netflix.
Yeah.
Do you think young investors are developing valuable skills by investing their entire savings into speculative assets like Fartcoin and holding through market dips?
Yeah. The rules of investing and how you invest change with different generations, right? This generation will invest in deep value. The next generation may invest in dividend payers. Maybe our children's generation will invest in more trading or come up with AI algorithms. I don't know. We don't know the right answer. All we know is...
No, I do know the right answer.
Okay, but
the answer is it's not Fartcoin.
Okay, it's not Fartcoin. It's not an investment, right? Someone said like all these coins, the Trump coin, the Melania coin, Fartcoin, Dogecoin, it really causes trouble to Bitcoin. I think the opposite. I think Bitcoin is more legitimate as a result, right? Because all these other coins, you have to mine them? Not in the same way, right?
Bitcoin I think they're based on different networks.
Yeah, Bitcoin has a limited supply, and it's very interesting. Bottom line for our clients is we won't be investing in any of these coins. If you want to do it yourself, give me a call and I'll explain to you how you can invest in these coins. But as a fiduciaries, we're never going to do it. Well, never's a long time, but we're not going to do it at all right now. And as for long-term investors, we encourage everybody to listen to our podcast, and we're preaching the goal of investing long-term, owning great companies for the long term. It works for us. I just explained it at the beginning of the podcast, the top 25 holdings, how many we've owned for such a long period of time and how well they've done. But that doesn't necessarily mean that that's going to work in the future, or that's, may not fit with, my son's strategy or your son or daughter's strategy when they start investing.
Yeah.
But I know it's easy to say, young investors are not in gaining
value. I get it. Yeah. Like if you have like $5,000, right? Like there's no point of owning like 30 compounders
Absolutely
in your portfolio.
Not. Yeah.
Right. And I think more importantly is like, losing $5,000. Like I think investors are a little more rational than they're often given credit for, where that $5,000 could be $100,000 if you nail the right Fartcoin, or it could go to zero.
So, but Ernest, when I started fooling around with investing in my early 20s, I had my first job. It was the .com boom. How different is this than Fartcoin? Even though I was buying companies, they were all baloney, bid.com and pets.com and whatever the heck else I bought. And I got lucky because it was right time, right place, and I got out and made a bunch of money. Did I learn a valuable lesson? Not necessarily, because I didn't lose money. But I knew as I got more experience as an investor, that's not the type of investing I want to do as I get older. So I think you got to learn by experience. I don't think that as you age as an investor, as you talked about what you learned, you can invest this way.
No, I don't think most people do.
Yeah.
I don't think like that kid with $5,000 once he has a job and is building up his RRSP.
Yeah.
I don't think he's buying Fartcoins in that.
I hope not.
Yeah. So I think it's a little discouraging to see, but I think that the young generation is going to be fine.
And Ernest, I'm going to ask you a question. So let's say at some point in time, all these coins blow up.
Yep.
What's the knock-on effect? Are we going to see a recession because of this? Are we going to see, or will the market just shake it off? Right?
It's hard to say.
Yeah.
It's really hard to say because I think people forget that this is like the third time that crypto or weird crypto stuff have really become popular.
Yes.
Once was 2018, then was 2021, and now we're in another era with these kinds of coins. And each time there was a market correction following it. I think some people lost a lot of money.
Yeah.
But if you own good companies, which is what we're talking about, then they'll find a way to figure it out.
You and I can hate it, but that's capitalism. And this is how it works. And Ponzi schemes and silliness and people thinking they're going to get rich and seeing their neighbor getting rich when they have no brains and buying these Trump coins and making a fortune makes other people get FOMO and YOLO. And people will say to us, "Why? Maybe I'll just put a few $1,000s into it. Fine. Just put money in that you can afford to lose."
Right.
So with that, we'll see you back here real soon. Thank you very much for joining us. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.